Modern CPA. Our purpose is to provide valuable information to small business owners. On our podcast, Profit Points, we discuss business how-tos, give tax tips, and dig into real-life experiences in the crazy world of running your own business. If you find this podcast helpful, then like, subscribe, and follow us on social media. Hey, everyone. Thank you for joining us on Profit Points podcast today, where small business owners, professionals, and industry leaders discuss the things that they see in the crazy world of running your own business. And today, Sean and I will be talking about payments to the IRS or states when you owe taxes now that you've filed your tax return. So welcome, Sean.
Hi, Michelle. How are you?
Good. So we, as a business owner, we finally have filed our tax returns, and we may have owed taxes with this last tax return. And sometimes people will pay those. A lot of times people will pay those upfront, right when the tax return is due. But there are instances when those taxes can't be paid at that time. And so what we want to do is kind of help our small business owners understand what options they have when they're not able to make those payments.
Yeah, the best piece of advice is to try to pay those taxes as soon as possible, because you filed your tax return, we're now past the due date, and interest and penalties on those balances that are due will accrue until you get those paid off. So option one is, pay it as soon as possible, along with the interest and penalties.
Yeah.
You may be able to, get out of some of the interest and penalties if there is some sort of, real good reason, like a medical reason or something like that. But it's difficult a lot of times to get out of those penalties. So
yeah, and sometimes people, when I hear and talk with some of my clients that are not able to make the tax payment immediately, they get upset about the fact that they have to pay interest and penalties. But if you were to go to a bank, or if you were to put it on a credit card, both of those entities would charge you some sort of interest. So although no one likes to pay taxes, it's the same concept, right? It's
right.
You're not making payments, so they're entitled to interest, basically.
Yeah, exactly. And it's unfortunate because it does increase the cost of what these taxes are due. And no one likes to pay taxes, and no one likes to have a balance due at the return, but there are instances where it happens, and cash flow issues or whatever could lead you to actually not being able to pay on time. So yeah. So
let's get into some of the options that people have if they are not able to make full payment on their taxes. And one of the things I do want to mention before we get into what those options are is we always suggest that the client make as much of a payment as they can to help reduce the amount of interest and penalties that are accruing. So even if you're not able to make full payment on whatever taxes are due, go ahead and make what you absolutely can, because that will help you over the long term.
Right. Exactly. Yeah. Reducing those interest and penalties is key, and getting payments in as soon as possible is also key too, because it also, once you start making payments, it kind of stops some of the more aggressive collection efforts by the IRS or state or local government agencies.
Right. Absolutely.
So starting to make payments as soon as you can, it helps in those efforts as well.
Okay.
So
what's an option that someone has in order to try and fulfill the tax liability?
Yes. So you filed your tax return. There's a balance due, and you've paid as much as you can at the time, and now you still owe. So first option in that scenario is an informal payment arrangement where you just send in payments monthly, or whatever time period you have, just not more than monthly. I wouldn't suggest waiting like every other month or every 3 months, but some sort of monthly payment. And then in that sense, if we would suggest you do that if you're going to be able to pay it off over the next 3, 4, 5 months.
Pretty quickly, short term.
Yeah, we're not talking more than a year or so. So an informal arrangement can work in a shorter term where you're just basically paying it off over 3 or 4 months.
Now, there's probably some more aggressive collections that are going to start coming in that time period. So it becomes a little more challenging with the IRS.
Yeah, I mean, the IRS especially. You have, you'll once you file the return and you haven't paid on time, they'll start sending notices out, that you owe money, and then after so much time goes by and they're not paid in full, they could. They'll start sending notices, the nasty notices of they're going to lien your bank accounts, they're going to garnish your wages. Those types of notices start coming out. So at that point, all along this process, you should be, talking with your professional and making sure that you're giving them those notices. So, they can be addressed if need be. But once you get to a point where they're wanting to garnish your wages and put a lien on, then contact with the IRS is required to, basically put a hold on the account so that you're not, they don't
seize assets.
Actually do those things. Yeah.
Mm-hmm.
And usually when you get a hold on an account, it's usually like 6 weeks. So you've now received multiple notices. It's multiple months down the line.
It's many months down the line.
Now you have an additional 6 weeks. So this is where we say, okay, you're in that 4, 5, 6 month range. You could have paid it off under an informal arrangement. Okay, so now the IRS hasn't liened anything or anything like that. So you've met those requirements. You've paid your interest and penalties, and they're not going to touch your wages or your bank accounts or anything like that. And the IRS has that that process. States and local governments have similar processes. Some are more aggressive or less aggressive depending on the rules
on the state,
what they have in place, right? So you just have to watch out and make sure you're in communication with your professional, and if you're doing it on your own, making sure you're contacting these governmental agencies and letting them know that there's payments coming and that you're going to do it. So that's the informal arrangement where you don't really have to file a form or contact the government to do that. You're just sending in payments, right? The other option is the formal payment arrangement. This is where you need longer than the short-term amount for 6 months. You need to spread this out over a year, 2 years, whatever,
or longer, depending on what is.
Yeah. So in that sense, we'll talk about the federal government, the IRS. You need to you could do this online. You can go on yourself and go online and fill out a form. It's not necessarily a form, but if it was paper, it would be a form, but it's the same process.
Yeah, it walks you through the steps.
Yeah. And if it's under $50,000, there's a streamlined form where you don't have to put a lot of information in. Right. Just the basic information, how much it's due, name, social security numbers, all that stuff. And then you tell them how much you can pay per month up to 72 months. So you could stretch it out over 72 months. Right. Again, interest and penalties are going to accrue that whole time.
Yeah. So one thing to note on the Streamline method that you go through with that is that they have an option in the other installment agreements where they could deny the installment agreement, but in the Streamline, it is automatic that they will accept you. You still have to go through the application process or that online process. That can be found at the IRS.gov website, but it is an automatic acceptance as long as you fill out all the information and you provide a bank account. Auto draft is what they will want for payment. So it does make it nice and easy to get into the installment agreement. And if the installment agreement is needed for a liability that is more than the $50,000, that's where different things need to come into play. And I don't know if you want to talk about that.
It gets much more complicated when it's over $50,000. So we recommend, if it is over $50,000, to make a payment to get you under the $50,000 to be able to get into the Streamline.
Yeah, especially if you're at that cusp. If you're like close, at 51, 52, and you're really close, then we suggest trying to make a payment to bring that liability down to get under the Streamline.
Right. If you can't, then the process requires you have to fill out financials, basically. So they want to know all your bank accounts, all your retirement accounts, all the assets that you own, real estate, audit cars, what debts you have on the real estate, values of all these things, how much you make through your business, through your wages, interest, dividends, what your expenses per month are for, or whatever period it is for living expenses. So it's a much more in-depth process and requires a lot of backup documentation. You have to provide statements and all kinds of information.
So one of the things I do want to mention is that if your business is pretty much the reason that you're having taxes due, but your business is considered what is considered a pass-through entity, meaning you pick up all that activity on your personal return and pay the taxes on the personal level, then when you file the installment agreement, it will be under your personal name, even if the business is what generated all of that tax, right? So even if let's say you're married and you have a spouse, your spouse has got to get into that as well if a joint return is filed. So all of this would be done under the personal Social Security numbers. Your spouse would be included if a joint return is filed. And so you would be completing everything for the business as well as the personal all together.
Yeah.
So it's something interesting to note. I just want to make sure people are aware of that.
Yeah. And what the IRS is looking for with all that information is there an ability for you to borrow from any of these sources? If there's equity in your real estate or equity in your autos, if there's retirement accounts, the ability to pull money out of your retirement accounts to pay these liabilities.
Yeah, they want their money first.
The IRS doesn't want to be the bank. Yeah. They want you to go out and do this on your own with through your banks or through your own personal assets. So that's why once you're over that 50,000, it becomes more difficult. Much more difficult. Yeah.
Yeah.
And there are fees involved with the arrangements once at different levels. So you will have
depending on the tax liability, the IRS has the option of placing liens on property as well. So they can and have done that.
Right. So So it's trying to get it paid off as quickly as possible, as streamlined as possible, is the best option for for your sanity, for one thing, and if your overall just the overall financial impact.
Yeah, exactly. So we talked about the IRS having the installment agreement. And one of the rules that I know is very important to the IRS is if you get into an installment agreement, they want to see, and they've cracked down on this a little bit more now in the recent years, is they want to see you stay current with your taxes. And I don't mean the installment agreement taxes, I mean the most recent tax year. So are you adjusting and having the proper withholding, or are you making your estimated tax payments for the current period so that you're not continuously behind the 8 ball and having to add to your installment agreement every single year? So I know that that's a big deal for the IRS in the more recent years. They've cracked down on that.
Yeah, that's one of the things that they, I believe it's in the installment agreement that you're agreeing to stay current on your taxes for the years following, the year following the where.
Yeah, I just haven't seen them really enforce that as much as they have. I think they're trying to do that more often now.
Right. Yeah, and if you don't stay current, they can negate the installment agreement and require full payment up front. So, yeah, so it's important to stay current with your taxes. So, getting your withholdings right, paying an estimated taxes. You may owe because of a one-time event, and it might not,
be an issue.
But if it is something that's going to continue, then you need to address that. So so making sure you get current on this year's taxes is important. Yeah.
So the last thing I want to mention is about states, right? So you could have a liability for federal and not for state. I guess there's instances where that can actually happen. But in the event that there are some state liabilities, what do you think some of the best options are out there? What would you suggest someone do?
Yeah, some states are every state and local government is going to have their own rules as to what they allow as far as payment arrangements. Some are more strict, some are more lenient. So you just have to look at the rules to whatever government agency you owe and see what is out there and what's available. If it's a matter of, let's say you owe federal, you owe state, and you owe local. So let's say the state is the most aggressive and doesn't have as good of a payment arrangement, then maybe you want to pay that one first, as opposed to and then you enter into the more lenient arrangements with the IRS or local. So kind of taking in all of the different pieces that you may owe on, and kind of seeing what is the best options in each of those scenarios, and paying off the one with the least options first.
Sometimes I know some clients will, since they can get into an installment agreement with the IRS, they may pay off, let's say, their local taxes if that jurisdiction had one. They may, and it's typically a smaller amount too. So they may be able to put more and just pay that off and be done with it, and then focus on paying down the installment agreement, which leads us to the ability to pay the installment agreements. Most of the time, you're able to make full payment at any point. So once you get into an installment agreement, whether it's the IRS or some sort of state, the ability to make payment, they're always willing to take whatever you can give them. So prepaying is good.
They won't bark. They won't bark at getting their money sooner. That's for sure. So, that's always an option too. You can, as you said, the IRS you'll be able to stretch it out longer, just to kind of give you some financial freedom, some cash flow freedom, and then with the intention of paying it off earlier as things kind of settle down for you or get a little bit better. Yeah. That's an option.
So any other tips that we should be kind of communicating with our small business community here?
Just, make sure you're cluing in your professional with what's happening. Don't ignore notices. Once they come in, it's hard to, it's sometimes stressful. We get a lot of panic calls and emails with, "Do I get this notice?" But don't panic, but address it right away, and get your professionals involved. If you're doing it yourself, make sure you start getting that ball rolling of getting those taxes paid off.
Yeah.
Last thing you want is, to have your bank account seized or
Yeah.
money's
That's
taken
just
out
bad
of that,
news.
or your employer's being notified that they're going to garnish your wages. It's not something you want to deal with.
Yeah. Yeah. So catch it up front. That's good.
Yep, exactly.
Awesome. Well, thank you for joining me today. And I'm so glad that we were able to have a conversation about this. And I think there's a lot of useful information.
Yep, I agree. Thank you.
All right. Bye-bye.
Bye.
If you find this podcast helpful, then like, subscribe, and follow us on social media.